Hunter, what are we talking about today?
Victor, we're talking about something that's near and dear to a lot of people, is qualified and unqualified accounts. While it's not the most exciting thing in finance, it's really applicable to everybody out there. I'm sure most of our listeners, if you have any amount of money invested at all, it's very important as you're building that wealth, building your savings, to understand really the difference between what qualified and unqualified accounts are, the different types of qualified accounts, and where those are best utilized and how to utilize them.
Yeah, no, exactly right. Asset location matters. And because a lot of times you and I were talking about economic finance strategy, investing strategy, talking about asset allocation. Well, asset location in many cases can be just as important. And that's really kind of foundational to how you're setting up your investments. So to kind of break that down, unqualified versus qualified, I think the easiest way to explain it is a qualified account is going to have some kind of tax preferred treatment to it. And that's typically an IRA or traditional 401k, which is pre-tax dollars that are going into that account that are going to grow tax-free until you pull them out sometime in the future. Now, typically that's after 59 and a half, kind of noted as the official retirement age for those accounts. And then at age 73, you now have to take what are called RMDs, required minimum distributions on those accounts. And then the other form of qualified account is a Roth, either a Roth 401k or a Roth IRA. And those are post-tax dollars. So you've already paid your income tax on those, and those grow tax-free over the life of that account. And so once you pull that money out, you don't get taxed on that. And so those being those qualified accounts, and then unqualified, just think of your regular brokerage account, Robinhood account, Fidelity account, whatever it may be, where you're just putting your post-tax dollars in, they grow, and then you pay capital gains at the very end once you pull that money out.
And so I think this is so important to understand how it works and why utilize them, because tax is something that we spend a lot of our time focusing on, because it's, returns we can work our best to achieve, but tax, we have direct control over where we put money, how we, what we sell, what gains we realize or losses we realize. Taxes we have a direct hand in. And so that's something we can control. And these accounts are a great tool to allow us to control that tax burden to people. So you were talking about IRAs and your traditional 401ks. Well, that will reduce your tax burden this year as you make those contributions. These are pre-tax dollars. So instead of withholding at your normal rate and everything, the whole, gross amount goes into these accounts, which is very powerful in getting a larger total number to compound over years. And then on the flip side, with your Roth basis accounts, these are after-tax dollars, but they can be really powerful because they get to grow tax-free over your life, over the life of the account. And then whenever you're at the end of your career, maybe you're still working in a high tax bracket, and usually, we'll get to this later, usually at a higher tax bracket than you are when you're initially putting those dollars in. Once you take them out, you're at this high tax bracket. The Roth funds are tax-free. The dollars that you paid in, as well as any growth you've accumulated over all of those years. And so one thing that I think is really important about these is that qualified accounts also make our jobs easier, because as you buy and sell things within the account, you're not realizing capital gains the same way you are in individual accounts. And so that lets you manage it a lot more closely, sell exactly what you want to sell, buy exactly what you want to buy, rather than having to worry about any tax implications of a position that's up 100 to 300% perhaps.
Right. I mean, you were spot on with that. I think some of the big things that you can control when you're talking about investing are, one, the fees that you're paying. So, whether you're paying a fee to a professional advisor who should be paying attention to all of these account differentiators. And then two, the tax treatment. So something that's, critically important and that is within your control is how you are taking capital gains if it's an unqualified account. And then, are you putting your assets in the right accounts those qualified accounts to get the most out of that. And so I think it makes sense for everybody to have some form of IRA, whether that's a traditional or a Roth. And then if you have an employer, it's very likely that you have a 401k. But as we'll continue to talk about, there are some contribution limits whenever it comes to those, right?
Yeah, there are. And so you see that primarily in your IRA and Roth IRAs, whereas 401ks get, more generous treatment with, you can deposit up to $23,000 a year into a 401k. That's mainly to incentivize companies to offer a 401k program. Usually your investment choices are a little bit more limited. And so it's like you have the guardrails up a little bit more. Whereas an IRA, Roth IRA, you only have about a $7,000 contribution limit per year. That is $8,000 if you're old enough, but for most people, it's $7,000 into one of these accounts. And, that $7,000 is important to hit if you can every year, whether it's moving money just from an individual account into a Roth or just, savings as you go throughout the year.
Right. So taking advantage of those, tax qualified accounts first is kind of the best step forward to, put your initial contributions into those, whether it's your 401k. And I think a really critical part is to mention about 401ks is that, yes, you're using pre-tax dollars, but also many employers have a matching system on those investments. So if your employer is willing to match up to 3% of your annual income, max out that 3%. That's 3% free money that you can get, but it does require you to contribute to that 401k. So make sure that you're doing it.
Yeah, that's 100% gain on day one. If you told me there's investment where overnight you can have 100% gain, I wouldn't believe you. But, in a 401k instance, that's exactly what it is.
Right. So it's critical if, for any of our listeners, if you have an employer who offers a 401k plan with matching, make sure you're maximizing that if you can. I mean, I would really suggest that. Like you said, 100% overnight, that's the best return you could get in the industry. And then just making sure that you're utilizing these accounts appropriately. But I will say that it's important to consider if you're contributing to these accounts, there are some stipulations around them. So I briefly mentioned earlier that in a traditional 401k or traditional IRA, you do have to wait until age 59 and a half before you can actually make withdrawals. So for example, if you're saving up for a house and you want to put a down payment on, you're not really going to want to put that into a traditional IRA. I will say that there is an exception there are some exceptions for withdrawals. And one of those actually is up to $10,000 for the purchase of a first house. There's some medical related exceptions, but for the most part, if you make a withdrawal before 59 and a half, you're paying a 10% penalty, which erases all of the value of contributing in the first place. So, be conscious about which dollars you're allocating. If it's for long-term savings, definitely maximize your contributions to a traditional IRA, 401k, or a Roth, because that's going to grow over the course of your life. And then once you're in retirement, you're going to get that preferential tax treatment that is going to help you, set yourself up for success in retirement.
And one important thing to call out here is that a Roth IRA can be a little bit more flexible in that way if you have an emergency expense or, something that's not covered by an exception of a traditional IRA or a 401k, in that you can take out any contributions tax-free, penalty-free, because they're already after-tax dollars. But what you run into penalties for taking it before 59 and a half is on any gains you had. So there is a lot of accounting that goes into that. Like you have to make sure that your taxes are done right. And it's important to be on top of that, because otherwise the IRS will just assume, oh, these are gains, great. But so as long as, you jump through those hoops, you can withdraw any contributions to a Roth IRA early without penalty. So that's, an important thing to keep in mind as you're utilizing, probably more than just one of these accounts. There's a place in your portfolio for 2 or even 3 of them, depending on your situation.
Right. And many of our clients who are listening to this conversation are familiar with the RMD process, the required minimum distribution process through a traditional IRA. Now, I think it's also important to note that that is not required on a Roth. And you may ask why that is. Well, we just said pre-tax dollars go into a traditional. And so the government eventually is going to want to see some tax revenue from that. So once you turn 73, you have to start pulling money out and paying taxes on those contributions, on those gains. And so there's a required amount depending on your age that you're going to have to start pulling at age 73. Whereas the Roth, you already paid the taxes, so the government doesn't really care how long you hold it. No required minimum distributions on that. And I think it's also important to know, I know you mentioned earlier that there is, there's that salary cap where you can't contribute to a Roth anymore, which I don't know why they haven't changed the legislation around this yet, because it honestly doesn't make sense. Because I'd love for you to, kind of briefly walk us through. You can always convert a traditional IRA into a Roth IRA.
Yeah. So for a Roth IRA, your traditional limits, a single person can making up to $146,000 a year can contribute your full $7,000. It tapers off after that. And then married couples is around $230,000 of joint income is your maximum you can make and still contribute your $7,000 a year. Well, that's pretty relatively on the low side for a lot of these rules and laws that we deal with nowadays, to your point about them updating any of this, because what you can do once you surpass that income level, single or jointly, is do what's called a backdoor Roth IRA, where you take an individual traditional IRA, contribute money to that because there's no salary cap there. And then you can convert that, roll it into a Roth IRA without any penalty due to your income level. So there's a way around it. It's a little bit, some more hoops to jump through. And it's a very well-known and well-practiced thing that's been around for a very long time. It's not anything that the IRS, SEC isn't aware of. It's just a hoop that they make you jump through because of this state of legislation.
Yeah. And I think that the important part is if you're thinking about doing a Roth conversion, it's important to talk to your financial advisor beforehand, because there are, individual circumstances matter here. I think you want to have a time horizon before you're going to do withdrawals of, at least 10 years probably to make up for the taxes that you're going to pay now versus in the future, converting that traditional into a Roth. And so what you really want, if you're going to convert to a Roth, is to be, paying a lower tax bracket now versus in the future. So say maybe you go through a year where your income happens to be significantly lower. Maybe you have just left a job, or your small business, didn't retain a lot of income for the year. It might make sense to convert in that year because you're going to go ahead and pay the taxes at a lower rate. And then if you expect later on in retirement, maybe you've got a lot of investment money, you're be paying a higher tax bracket, it may make sense to do that conversion, because then you're getting that tax preference. You're in a Roth now, which means all the money's tax free. You can also apply this to, politics kind of in general sometimes, because if you're thinking about legislation, well, we've got the Tax Cuts and Jobs Act, which reduced the individual income tax bracket to a peak of 37%. That sunsets in 2025 back to 39, a little over 39%. So you got to consider these things. Of course, it's really hard when you're talking about legislation that can potentially change every 4 years, but something to just keep in mind, something definitely to talk to your advisor about if you're thinking about doing a conversion.
Yeah. And to your point about consulting a financial advisor, is I really hope this information is helpful to all of our listeners, because I think no matter where you are in your journey, this is something that's worth knowing about, and, take your first steps and everything. But I think it's also one of those things where is a lot of complexity to it, and there can be a lot of considerations to make. And so I want to move into the asset location portion of this, a lot of smart things and a lot of, potholes you can step into given, all of your options out there. And, some examples we've seen, some examples we've heard of. Do you want to walk us through a little bit of that? Just kind of tell people what they should be keeping an eye out for here?
Yeah, for sure. And I think a lot of this is applicable to retirement when you're needing income. So you're going to have some income producing assets, whether that's dividend paying stocks, real estate investment trusts, bonds, preferred shares, things like that, things that do not have favorable tax treatment from a dividend or coupon paying perspective. You want those to go into your qualified accounts, because if you're paying ordinary income tax on those dividends, you want to be able to control that by placing it into a tax deferred account. So grouping those there, and then anything with tax preference, tax preferred dividends. A lot of times those real estate investment trusts have more tax preferred dividends. Those can go in your ordinary account because you're paying a lower tax rate on those. And then I think as far as if you're talking about your growthier stuff, equity, some of your high growth names might make sense to go into your Roth, because if they really explode over a period of time, say you've held NVIDIA for the last 20 years and it's up 20,000%. Well, if it's in your Roth, then you're not going to have to pay capital gains on that whenever you finally make those withdrawals. So that can be a huge benefit if you're talking about those growthier names in your portfolio.
Exactly. And I want to, call out an example of you have, tax favored items, but one of the most famous is a Muni Bond, where it's tax-free dividends. They pay a lower dividend because they know it's tax-free, and it just allows municipal governments to raise money better. That's why they have this structure around, but your dividend that you're receiving is already lower because of this. And so that's a prime example of something that you would never, ever want to put into a Roth, or especially not into a traditional IRA. Because if you put into a traditional IRA, you're receiving these dividends that are tax-free anywhere they are until you come to withdraw that money at the end, and then you're paying income tax, or, you're paying tax on these IRA distributions, these 401k distributions. So that is the last place on earth you'd ever want a Muni Bond. Whereas, an individual account is the perfect place for it because it's the most tax advantaged, which I think kind of brings us to the overall rule of the more qualified the product is, put that in your individual. So the Muni Bond is the most tax advantaged product that there can be because it's tax free. That should go in your individual. And then your ordinary dividends and your, less tax advantaged items should go into your qualified account. So you just kind of balance your qualifications, if you will.
That's right. Exactly. And I think the whole story here is that asset location matters. Like I said, we love to control the things that we can be in control of. The market's going to do what the market's going to do. It's going to be up, down, sideways. But what we know is what's in legislation, what's in law, how we can see the tax treatment of these things. Of course, we are not CPAs. We don't give official tax advice, but as advisors, we have to be conscious of the tax implications of what we're doing. And so I would suggest to anybody who's listening to this podcast is, if they're working with an advisor, ensure that your assets are located in the right accounts. If you don't have an IRA, maybe that means opening one up, making sure that you're being smart about how to manage your finances, because nobody wants to pay the tax man at the beginning of each new year. So if we can avoid that as much as possible, that's great.
Exactly. Control the things we can control. So, just one more reason to go talk to somebody, get some advice from people around you, people who do this for a living, that kind of stuff, because it can make a huge difference in your retirement income, in your retirement lifestyle.
Absolutely, Hunter. Well, I think our listeners have something to take away from this conversation. So hopefully it was helpful.
Yeah, exactly. Thanks, Victor.